Income investors want one thing above all: cash flow. They want as much of it as possible, and ideally, every single month. Covered call ETFs make exactly that possible. And recently, these funds have finally arrived here in Europe. But among all the new options, one ETF is already dominating the market. We're talking about the JPMorgan Nasdaq Equity Premium Income Active ETF. No other covered call ETF in Europe has attracted this much capital this quickly. So the big question is, why? What makes this fund so special? And who is it actually built for? In this video, we'll take a closer look at this ETF to understand what's really behind the hype. At the end, I will give you my honest take and tell you if I would buy it myself. Before we start, the usual quick reminder. This is not financial advice, just my own opinions and experiences. The JPMorgan Nasdaq Equity Premium Income Active ETF, better known as JEPQ, has been trading in the US since 2022. In that short time, it managed to collect over $40 billion in assets. That is massive. On US Finance YouTube, JEPQ is a big deal, and for good reason. The ETF offers a yield of around 10% per year, paid out as cash every single month. At the same time, it invests mainly in technology companies and follows the Nasdaq 100 as its reference. This gives high-yield income investors direct exposure to tech, a sector known for tiny dividends. Since late 2024, JEPQ is also available here in Europe. And what can I say? It has taken off here as well. Assets under management have grown steadily, already crossing the €3 billion mark. And for the European market, $3 billion is a huge milestone. Beside JEPQ, JPMorgan actually launched 3 other covered call ETFs in Europe. Take a look at this comparison of all 4 JPMorgan covered call funds. The Nasdaq version we're talking about today, the S&P 500 version, the global version, and the European version. Looking at total fund size, JEPQ is easily the crowd favorite. The globally diversified version, JEPG, actually launched a year earlier, yet it holds significantly less capital. While we have this comparison open, we can quickly look at a few other interesting facts. Here you can see the total return for each ETF. The track record is still short, but it already shows why JEPQ dominates. Its one-year performance hit over 21%. For a high-yield ETF, that is almost unheard of, and the other JPMorgan funds simply could not keep up. There is another reason behind JEPQ's popularity. When it comes to distribution yield, it also clearly beats the other ETFs. So we get strong price growth combined with fat monthly payouts. What more could you ask for? This trend is continuing strong through this year. Since the beginning of the year, almost €1 billion of fresh money has flowed in, while JEPG is struggling quite a bit. The European ETF is still too new. There's barely any data yet. We'll have to look at that one in a separate video. Before we take a closer look, let's quickly clear up who this ETF is actually for. This fund is clearly designed for investors who want to build a solid and steady stream of passive income. It's perfect for retirees, people looking to cut back on work hours, or anyone like me who loves strong cash flow and is working toward financial independence. So, who is this ETF not meant for? Mainly investors who care more about maximum portfolio growth than cash flow. For them, sticking to a low-cost accumulating ETF usually makes much more sense. But as you know, around here, cash flow is king. So, with that in mind, let's break down what the JEPQ fund actually has to offer. At its core, this ETF is essentially the same as its US counterpart. It carries the exact same 0.35% expense ratio and uses the same active management strategy, run by the very same team. Of course, you get the exact same underlying companies, since it follows the Nasdaq 100 as its benchmark. However, every investor should keep in mind that portfolio diversification here is fairly limited, just like with the standard Nasdaq. The top 10 holdings alone make up 50% of the entire fund allocation. And here is how the sector distribution breaks down. Heavy concentration in technology. Communication, which includes Google and Meta, essentially another branch of tech. Consumer. Cyclical, featuring Amazon and Tesla, which also behave much like tech stocks. Bottom line, just like with a normal Nasdaq 100 ETF, you get almost no sector diversification, only heavy tech exposure. Such a focused allocation creates higher overall volatility, but it also brings unique opportunities. Volatile stocks yield higher option premiums, which explains JEPQ's unusually high payouts. If you are new to option premiums, here is how the mechanics work in a nutshell. The ETF actually owns the physical shares, like NVIDIA. At the same time, fund managers sell other market participants the option to buy those NVIDIA shares from the fund. This agreement sets a specific expiration date and a fixed strike price. In exchange for granting this option, the ETF receives cash immediately in the form of a premium, which is distributed to shareholders. On the expiration date, the buyer can exercise their right to purchase the NVIDIA shares at that preset price. That is the core process. So, what is the trade-off? Well, if NVIDIA's stock price explodes upward during that window, the ETF is still obligated to sell at the agreed price, capping its participation in the rally. In simple terms, a covered call strategy trades away upside potential in exchange for immediate cash flow. Let's face it, by design, a covered call ETF can't beat its benchmark over the long run. It's built for cash flow. To see what I mean, let's compare JEPQ's total return directly against a standard Nasdaq 100 ETF. Admittedly, the historical data for the European version is still brief, but the trend is clear. The plain Nasdaq 100 stays ahead. During a mild pullback in March, the standard Nasdaq recovered rapidly and pulled away from the covered call version. And if we look at the original US version of JEPQ, we can analyze a slightly longer track record. That longer view highlights the performance gap even more clearly. When measuring total return over the last 4 years, the standard Nasdaq generated roughly 50% higher returns, which is substantial. However, let's be fair. High-yield income investors care primarily about 2 key factors. First, consistent cash flow. Second, steady capital growth. And so far, JEPQ has delivered on both fronts effectively. Now, let's talk about cash flow. Let's look at what JEPQ has actually delivered so far. Last year, it paid out nearly 10%, and it's on track to deliver around 10% again this year. I have to admit, those numbers are incredible. I mean, before covered call ETFs came along, income investors had to settle for 3% to 5% yields. On screen right now, you can see every monthly payout the ETF has made so far. Because of market volatility, these payouts fluctuate quite a bit. Overall, though, the distribution history looks really solid to me. There's one more key detail I want to show you. Take a look at the annual payouts for the US version of JEPQ. What blows me away is that these distributions have increased significantly every single year. That is definitely not something I would expect from a covered call ETF. I don't know how management pulled this off, but it gives me high hopes for continued payout growth in the future. So, with JEPQ, we get share price growth, massive dividend yields, and potentially even payout growth over time. So why not just go all in on JEPQ? Well, not so fast. We also need to talk about the risks. First, this is a purely US-focused ETF, which means you are taking on 100% US dollar currency risk. Second, it is a heavy bet on the tech sector. And third, most importantly, it's a covered call ETF. That means your upside potential is capped, while your downside risk is completely unlimited. If the Nasdaq crashes, JEPQ crashes too, and it hits just as hard. Right now, there's a lot of talk about an AI bubble in the tech sector, and if it bursts, things could get ugly for JEPQ. During the dot-com bubble in 2000, the Nasdaq plunged by 80% and took about 15 years just to get back to its previous high. A covered call ETF would likely never recover from a crash like that, at least in terms of share price. Granted, the dot-com crash was a very specific event. Today's tech giants might be overvalued, but they generate massive profits and have a bright future ahead in the age of AI and robotics. Because of that, an 80% crash seems very unlikely to me. A more realistic scenario is a 40% or 50% correction in the Nasdaq, followed by a relatively quick recovery. Even so, a pullback like that could keep JEPQ in the red for a long time on paper, even though your cash flow stream would remain intact. But get this, a market crash isn't just a risk, it's also an opportunity. Investors who buy heavily during a dip can build an insanely strong foundation for the future. To wrap things up, here is what I can say. JEPQ is a highly appealing income ETF and one that I personally really like. Both its price performance and payout history have been genuinely impressive so far. This fund is especially attractive for high-yield income investors looking to add tech exposure to their portfolio. Traditional tech-heavy dividend ETFs like the Fidelity U.S. Quality Income ETF offer tiny yields below 2%, so most cash flow fans simply skip them. Meanwhile, JEPQ shines with a massive payout of around 10%. So, is this the ultimate retirement fund? Well, it is definitely a solid product that could make a great building block in a portfolio. However, because of the risks we discussed earlier, I would never allocate too much into an ETF like this. Personally, I would only use covered call ETFs as a satellite position in a portfolio. For example, a split like this. Or like this. I don't hold JEPQ in my own portfolio yet, though I am definitely considering adding it at some point. So why haven't I bought it yet? Well, there are a few reasons. First, I already have huge tech and U.S. exposure through ETFs like the Fidelity Global Quality Income. Second, I want to see how JEPQ handles a true bear market first. But unfortunately, we haven't seen a prolonged market crash since 2008. And there's actually a third reason why I haven't pulled the trigger on JEPQ yet. I am closely monitoring the covered call market to see what new and potentially better products emerge. Over in the US, we're seeing JEPQ face a lot of fresh competition. Some of these newer ETFs offer even higher payouts or better share price performance. It wouldn't surprise me at all if similar funds start popping up here in Europe soon. In fact, one potential candidate is already here, the Invesco Nasdaq 100 Income Advantage ETF. However, it's still way too new for us to draw any meaningful conclusions. Since I don't need to live off my cash flow just yet, I'm happy to sit back and see how things play out. But hey, that's just my take. Everyone should invest in a way that fits their own strategy. What do you think about the JEPQ ETF? Do you hold this one or any other covered call ETFs in your portfolio? Let me know down in the comments. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.